Hello, everyone, and welcome to the iSpring Solutions webinar series, where every week we talk about e-learning trends, share iSpring tips and tricks, and cover clients' cases. My name is Paulina. I am the community manager at iSpring, and I will be the moderator for today's webinar, where we'll be covering a great topic and actually talk about return on investments and how business leaders actually evaluate learning investments. And to cover this topic, I have invited a great presenter, Ajay Pangarkar, who is the president, partner and consultant at CentralKnowledge. Hi, Ajay. How are you doing? And thanks for tuning in.
Well, thank you, Paulina, and thank you, iSpring, for having me here today to speak on this topic, which is quite, as people who may know me on who are participating today know, it's a great passion of mine. So thank you.
Perfect. Awesome. So before I pass the mic over to you, I would like to cover a couple of tech moments. So guys, if for some reason you will not be able to sit through the whole session, don't worry, it's being recorded. So you will receive a link to replay sometime after the webinar pretty soon. However, I would like to encourage you to stay till the very end because we are going to have a Q&A session and it will be an amazing opportunity to address your questions directly to our today's presenter. And to do so, please submit them in the question box, which you will find on the right side of the GoToWebinar panel. And right now on the screen, you should see how it looks. Okay, I think it's all on my end. So, Ajay, let me pass the mic over to you as well as the presenter rights, of course.
Perfect. Thank you for this. And it's a pleasure to be here. And I want to thank iSpring again for inviting me to speak to all of you. It's always a privilege to share my knowledge and answer any questions that you may have. To contextualize this a bit for all of you, number one, this is about what I call the real ROI, and I'm not sugarcoating it because the perspective I'm taking is from a leader's perspective and how they actually look internally to calculate return on investment for money they allocate for different activities within the organization. So I am not going to be speaking to anything like a training ROI or anything that we've created. When I say we, the collective we of learning and development within our scope, because those calculations, and I'll be very frank here, are not valid in the eyes of your stakeholders. They are formally educated in business and have been learning very specific methodologies to calculate return on investment within the organization and apply it to appropriate relevant items. Now, I say that purposely because one, a lot of their rules that they follow as ROI, we can't just toss this around, informally, because it does mean something to your business leaders. They have been trained and educated in terms of things like international financial reporting standards, generally accepted accounting principles, and all of the basic financial and accounting principles that you can find in basically any textbook. And so we cannot move that needle because that's the needle that they're looking at. So we cannot create things that they do not recognize and that do not apply to them, which does not lend credibility. So the reason I'm qualifying this is because, number one, my formal background is as a chartered professional accountant. I'm a fellow of the profession and CPA in Canada. And all my methodologies and what I'm showing you is not, excuse me, is not specifically attributed to me. I do not have a methodology. I'm not trying to sell you anything. I'm sharing you the methodologies that your leaders have been educated in and that they apply to your initiatives. And so you can open any business textbook and you'll find everything that I talk about in this presentation. So if you have any questions, please feel free to ask me. I am an author as well. I've written 3 books. The recent one is the Trainer's Balance Scorecard, and I hope you get a chance to take a look. It's published by Wiley. It speaks about performance management and how to connect to performance expectations within the organization. Moving on. So if you'd like to reach out to me on Twitter, this is my Twitter handle, and I encourage you to do so because I do use it as a learning tool. I write for several publications, and I share all the interesting articles I come across with my followers, and of course, I hope to follow you and learn from you as well. So I use Twitter as a learning tool and nothing else. So I do hope you get a chance to join me, and if you find anything valuable today, I hope you get a chance to tweet it as well. So my first question to you before we get started is that we are all in learning, and we expect our participants, when we offer a training or a learning session, that they leave with some interesting elements that they can apply in their workplace. And because that's what's really important. If you want to talk about ROI for learning, the real truth comes when you actually get people to apply the skills to make a difference in their work. And so my question to you is the same thing that you would ask for your participants. What will you do Monday that will make business sense, that will show a business impact for you in your environment? So you may not have that answer, maybe you do. However, I want you, by the time we end this, I'm going to ask you this question again, and hopefully you will have noted down one item that you will take away. And when I say Monday, I know it's Thursday, but at least starting Monday next week, that you actually apply it and get some value out of this presentation, because I hope you really do get something from it. So I'm going to ask you a very quick question here. First, I have 3 products in front of you, and the question to all of you, and unfortunately I'm not looking at the chat box, Paulina, so I hope you can help me out here if you see any interesting comments. We have Post-it notes, we have Q-tips or cotton swabs, and we have specialty coffee from, of course, the ones who created it in the first place, Starbucks, or popularized it, I should say, not created it. So what do these have in common in relation to learning and development? I'm going to put a little context around this, because I know people are going to say they're strong brands, they're profitable companies and all that, and we understand that, but those are the results. What brought these products to fruition to lead organizations like Starbucks and 3M and I believe it's Procter & Gamble, if I'm not mistaken, to come up with products so innovative that we take for granted now? I'm not sure if you see any interesting answers, Paulina.
Well-known brands,
Okay.
accident, discovered by accident.
Okay.
They meet a need, they are useful, they are essential.
Okay. Well, they're essential now, but we didn't know we needed them back then when they weren't created. We lived without them, and now we take them for granted. But I won't keep you too much in suspense. Let me just share with you that these products arose from learning events that delivered actual business results. And that's really when we talk about a return on investment per se for learning, this is what we're looking at. So it's important that you realize that, and I'll talk a little bit accounting wise, and I'll get maybe a little more in depth a little later on, but accounting, excuse me, the learning function is a support function. And so we're not expected to deliver a direct correlation to profitability, but we are expected to provide support and enablement to creativity and innovation and development of interesting things within an organization. So while some people say it's accident, and in some cases it could be, accidents have to be fostered. So unless you recognize it's an accident, the product would have never come about. And I believe the person speaking to is really about 3M, the Post-it note. It was an accident to a certain extent, but the people in 3M and the support function of learning had to recognize that that accident can be leveraged into something. And so that is the real impact. So leaders of these organizations recognize that learning behind the scenes is central to their success. And that's really I'm trying to point out to you. So if you feel lonely or isolated by your business leaders and that you don't add any value, 2 things are happening. Either they don't really believe in your offering, and then maybe you are working for an appropriate organization who doesn't believe in learning, and you need to find organizations that actually focus and leverage the learning within their organization. And trust me, I've worked with some of these organizations and these leaders, and surveys have been taken. The top 3 to 5 preoccupations for senior leaders, CFOs and CEOs and so forth, learning falls into the top 3 or 5 preoccupations for them. So know that you are valued and you are important, but we still have to prove that we show value. Otherwise, we're not going to be seen as a resource. So today we're going to look at 4 things, and I'm going to go through this relatively quickly. And I'm going to pre-qualify to say that I'm not here to take away your subject expertise in learning. That's what you were hired for, and that you should be proud of doing that. However, I'm not going to create any learning business or financial experts in under an hour. But I do hope that you gain some awareness and literacy around these concepts, because that's all I ask, is that when you talk to business leaders in your organization, is that you have some awareness and literacy around what they're talking about to accentuate and enhance your learning subject expertise if you want to gain support for your learning initiatives. So we're going to look at how leaders see training. And I put this in quotes purposely because your leaders look at training as an umbrella term that means everything that means learning within the organization. So don't take offense with that. And I'm going to use terminology they use so you can get into their heads. what leaders expect from investment. So we're actually going to look at what the term investment means to them, and not what it means to us necessarily. And then, of course, the financial impact of learning, and of course, more importantly, the value, the qualitative value that we bring to the table. So let's continue on here. So I'm going to ask you a quick poll, and I believe Paulina kindly created a poll for me. The question is, how do your leaders position training, quote unquote, in your organization? Is it a necessary event, meaning that they actually have to do the training, so things like onboarding or compliance? Is it part of a major initiative or investment? Is your company launching a new product or purchasing a major asset where you are part of that function to be able to develop some learning functions in it? Is it actual investments in training, meaning that you have to buy certain technologies or equipment for training, or they don't see value at all? So I'll give you a minute, a couple of seconds here for you to answer.
So the poll is right now up and running, and you guys are more than welcome to vote for whatever option you think is the suits you best. And so far, we have the most answers or the most votes for the first option, expected training.
Okay. So we'll give a few more seconds and then we can close the poll. It'll give everybody a chance to answer. Or if you see it quieting down, Paulina, I'll leave you the discretion to close it when you feel appropriate.
Okay. So I think we can close it right now, and I will share the results really quickly, okay?
Perfect.
All right. So
Okay.
the results are right now on the screen. Can you see them, by the way?
Yep, I can. I hope everybody else can. So we have a tie between the first two, the expected training and the part of the major initiative or investments, and then the rest balance out. And I have empathy for those of you who voted they don't see value at all. I really, really wish you that you can help them see the value in it. And unfortunately, the hard truth is if you're in an organization that doesn't show value, you may be, unfortunately, in this day and age, it might not be wise to change a job, but eventually when things settle down, you may want to look for opportunities in areas that offer you that organizations that will show value. So let's see what I'm talking about here. So it was a bit of a leading question that I'm sharing with you. So when I speak about expected or necessary training, as I mentioned, we're talking about onboarding or compliance, so things that need to happen. And in this context, they're giving you money. They're not asking for a return on investment. What the return they're asking for you is actually that people know what they're doing when they come on board. So when you get a new employees, they actually can do their job properly, right? That's the key here. The second one, of course, is impact within major investments. So we're looking at things like if a company is deciding on a new product release or a major purchase within the organization, what we call capital expenditures or capital investments within the organization. So to consider, I always use the example I use over and over again is something like extraordinary, like Apple launching the iPhone in 2007, 2008, where that took years of planning to do to get to that point. And within the couple of years before that, as they're planning the launch of this new product, excuse me, launching this new product, they had to factor in all the what we call the cash outflows that have to go out to support the product. You remember the old saying, you have to spend money to make money? Well, companies have to spend money, and these are all the cost centers, and training being one of them, including finance, accounting, and production, and all this kind of stuff, are all support functions that they have to spend money. So we will talk about that in a little more detail. Or purchase, right? If they're buying a factory or a major initiative that they have to buy, these are things that training does fall into as a cash outflow that needs to support that initiative. The third one, of course, is major tangible investments in training requirements. So this is probably closer with something that you can relate to, because a lot of you have wanted to buy maybe an LMS, or you have to buy some e-learning software or course software, maybe computers or tablets for the organization because you're launching an e-learning initiative, whatever it may be, but these are major tangible investments. And this, because they're tangible and also capital expenditures for the company, or capital investments, I'm using that term interchangeably, there is a financial ROI attributed to these things, but not in the way you think or the way that's been proposed in learning and development. So let me go and see how good we are here and look at this thing. So there's a balance between, from a leader's perspective, of the investment in learning from a performance perspective, meaning to improve the performance of the organization, and the financial perspective, okay? So as I mentioned earlier, expected necessary training, the compliance and the onboarding typically focuses on performance. And you understand what I'm saying here. And when I say not financial, it doesn't mean they don't put any weight on financial, but it's not the focus. They're giving you money to skill people up in whatever that is. That's a necessity, right? So we hire new people, we need to get them skilled up. We need to know that they can do the job that they were hired for and understand the organization, or they follow safety procedures or whatever it may be. It's all about performance. They have no choice but to spend the money. So they're not really asking you to measure the output of the financial performance here of the learning. The financial performance, that the money they gave you, just want to know that people can do what they need to do and you did a proper job doing it. That's one of the easy ones, okay? When it comes to impact within major investments, what we're looking for is a couple of things here. There is performance and there's financial. More the focus is on financial, but if you'll notice, I put a little star above the X, and that means something we're calling their cost adjustments. And I'll get to that in a second. So financial, because when a major investment, so consider the iPhone launch or purchase of a major asset within the organization. These are what we call in accounting capital expenditures or capital investments. And these assets, whether it's a product launch or an asset that they're purchasing, are measured on a return on investment basis. And I'm going to show you the calculations in this context. You'll hear things like net present value and internal rates of return, economic value added, this kind of stuff. All these return on investment tools that are official return on investment tools, not the stuff that we create in training, that measure the investment's return on investment. Now, here's where it gets a little bit interesting. Well, I should say a lot interesting. And I don't want to go down the rabbit hole because I get a little passionate about this stuff. When you're talking about financial and you're measuring ROI, it also means the performance of that initiative. So if it is a launch of a new product or purchase of an asset, they want to make sure that that asset is going to return value or some indirect financial value to the organization over the long term. So when we talk about the iPhone in 2008, chances are the life cycle for the iPhone when they had to estimate the return on investment was maybe about, say, 15 years. I don't know what the time frame is, but it's usually a long period. Or if they buy a major building, that usually has a 20 or 30-year life cycle. And so they'll measure the economic viability of those things over that period of time. Now, the simple thing is, and I'll speak about this again, is about net present value or present value of that value over that life of that asset or that initiative. Now, I'll get back to that point in a minute. But what they're going to do to you is this. They want to improve the performance of that. They want to increase the return on investment of that initiative. With that, they're going to come back to you, and not personally just to you. They're going to go to all the cash outflows or all the support functions, the production, the marketing, the finance, the HR, the training, because they're all factors of supporting this initiative. They're going to come back to you and say, can we reduce the cost, right? That's costing us to do this. And they're going to come back to you and say, can you reduce the cost of training? Now, there's a couple of things you have to keep in mind here. They're not telling you to reduce the cost. They're asking you if you can reduce the cost. Because whenever they ask to reduce the cost, they're trying to improve the return on investment of the overall major initiative. Okay, I hope that makes sense to everybody. So you have to say two things. Either no, this is the bare minimum to make sure that we are effective and people get what they need in training to be able to learn, or find new ways to help them reduce the cost in that. So maybe you're doing an instructor-led courses for this initiative. I'm being extreme here, by the way. And you decide, well, maybe we can do some of this e-learning and that might reduce the cost a little bit overall for displacing people. So we might be able to shave a little bit off the top of the cost of training. And that helps them improve the return on investment of the overall project. That's what I mean by cost adjustment. So you have to have the wherewithal to support why it costs so much to do this learning. They're not necessarily challenging you. They're trying to see if they can improve the overall ROI. I hope that makes sense. I'll pause a second, Paulina, in case somebody has any type of burning questions. And I apologize because I'm not looking at the stream right now in the presentation mode. So
I think we can keep going now.
okay, thank you. So the last one is a major tangible training requirements. And similar to the one previous point, this is where, of course, you are looking at financial and performance, meaning that Whenever you ask them to buy, let's say an LMS, I use the LMS as an example. We're all screaming about having a good LMS internally. And the LMSs can cost anywhere from, a few dollars, a few, I would say a few thousand, but a few tens of thousands of dollars, all the way up to, $1 million or something or more. This becomes what we call an asset to the organization. And like all assets that the company buys, the desk you're sitting at, the computer you're using, all these assets are only bought if they add value to the organization. Otherwise, they're not purchased and they're disposed of. So if you're going to ask for an LMS, you have to prove, one, that it's going to improve indirectly the performance of learning, the learning function, and deliver value for the people using the LMS, so the employees. And of course, you have to prove the capital investment side of things, which I don't expect you to become experts, but this is where I expect you to become friends with your accounting or finance people within the organization to help you understand these concepts and help you build a better business case. But when you want to build a business case and you want to buy an LMS, don't say we need it. You need to build a proper business performance and financial case around it, so your business leaders can wrap their minds around what this means for the organization and what value it drives to the organization. Okay, so I basically given you a bit of a accounting 101 aspect here, and I'm going to take it a little deeper in that. So let's do another poll before we get further. So and I sort of gave it away a little bit in the previous discussion here, but the poll is, how do you leaders refer to investments? So the question is it any internal activity expected to provide value? Is it about long-term assets to help the company run more efficiently? Or is it about acquiring permanent assets for future results? So I'll give you a minute here to answer the question.
So far, the most popular choice is the second one, long-term assets to help the company run more efficient.
Okay, so let's show the results, Paulina, and see what comes up.
Okay, so let me close the poll and share the results.
Perfect. So
Okay,
long-term assets. Well, you guys are on the right track, but it's a little bit leading too. So we got a bit of a balance. So I wasn't trying to trick anybody. I just wanted to see where people's understanding and hopefully open their minds to what the word investment means to your business leaders. Okay, thank you, Paulina. You can close that poll. Okay, let's get into the term investment. So the term investment is not meant to be used loosely. And I've taken this, to me, this definition from Investopedia is probably pretty accurate of what it means. And I'm being very explicit here because I'll read the definition to you and then I'll explain to you why I'm pretty adamant about adhering to the definition. So investment is an asset or an item acquired with the goal of generating income or appreciation. Okay. And the question I'm asking here is, and I want you to reflect, does your training efforts do this for you or for the organization? So does it generate income or some type of appreciation? And we're talking about financial appreciation. So why this is an important point, and we can't play with semantics around here, is because I have, and your business leaders, and maybe some of you too, who maybe earned an MBA in this area, recognize that when we learn the term investment, we are, and I use this in the most polite and kind fashion, we are actually brainwashed to look at the term investment in a very specific manner. Okay, and I know some of us say, well, we're putting investment in people and knowledge in people, and that's a generic term in investment of saying that we're just adding value to them. But when you speak to your business leaders, especially those formally educated in the financial side, which is most of them, like the CEO and the CFOs and the COOs, these individuals, and even operational leaders, like directors of departments, they have business backgrounds, have been told that investment means this. And you will not, it's like talking a different language. Once you throw the word investment, their mind switches automatically. I know when people talk to me about investment or return on investment, my mind goes into a certain space and certain calculations of what it means. So you might be just miscommunicating what you mean by that learning investment when you're speaking with them. Typically, training and learning is a cost center. And I'm not trying to be offensive here, but a cost center means, and let me back up a step. Every organization has different centers that we are educated in to learn about. And the reason that there's different centers, and we all know the centers typically, they're called profit centers, cost centers, and investment centers. I'm not going to speak to investment centers right now. That's more of a spin-off, but a cost center and profit center are the two most popular. Profit centers are the primary activities driving revenue to the organization. So these are the actual products being sold or services being offered that are generating actual revenue to the organization, and they are accountable to profit, okay, because they're bringing in the revenue. We are learning, and not just learning, and I'll out the other support functions. I mentioned them before: production, accounting and finance, marketing, training and development, HR are all cost centers. And because they're classified as cost centers, they're not expected to generate income as in terms of the investment definition. And these are hard accounting rules, okay? You can't deviate from this. This is written in the textbooks. You cannot deviate from that because they're not generating direct income or revenue for the organization. They're meant to add indirect value to the organization, okay? So keep that in mind. Just like in marketing, if you did an advertising campaign on a TV, while you might watch the Burger King or McDonald's commercial at 11 o'clock at night and decide that's what you're having for lunch tomorrow, and you go out and have lunch, and maybe you can attribute that to seeing the ad the night before, there's no direct correlation to prove that. Yes, we can admit that the ad maybe had some influence in you going to one of these restaurants. However, there's no direct, it's just a causal relationship, and at best. So even marketing can't prove that. Well, now they can, because now they have algorithms through websites, but that's a lot different story. And to a certain extent, we can do the same too, because we have LMS and technology to do that, see what people learn and how to apply the skills. That being said, we're still a cost center. There's no direct correlation to it. And we have to be careful, because cost centers are not valued as investments per se in the literal term that your leaders understand it. Okay, it's basically, and you've heard cost benefit analysis, and that's really where we sit. Okay, so just be careful of that. And cost is not a bad word. Because I call you cost center, I'm not insulting you. You should wear that badge proudly, because that's how they value you. Okay. So it's never about return on investment, but it's about meeting performance expectations. So if you make the connection to improve people's skill set within the organization, for them to become better, to do their jobs better, become more efficient, whatever it may be, that becomes what we call Kirkpatrick Level 3 application. And because they do those things better, whether they become more efficient means they're saving money, which increases profit for the organization, or if they do their job better and it makes the results output better, which has a business impact overall, you are now making a relationship to performance improvement, not financial return on investment. And I'm very adamant on this, because the training ROI people and that kind of philosophy is getting us, when I say us, the learning development space, into a lot of trouble with our business leaders and undermining our credibility. And I'm being very frank with you as a CPA. I'm telling you, as a CPA, it's getting you into trouble. Okay, so let's do one more poll. It's probably the last one. So how do you leaders evaluate initiatives then? So do they, when we look at this, do they apply learning tools? Meaning, do they look at the learning side of things specifically? Do they look at the infrastructure needs? And when they look at the initiatives that you're proposing, your learning initiatives, do they look at their own management needs, the business objectives and operating results and those kind of things? So I'm going to give you a few seconds here to answer this. And it's around evaluating learning initiatives.
So again, guys, you can see the poll on your screen right now, and please go ahead and vote for whatever option you think works best here. And yeah, let's allow you another maybe 10 seconds. Okay, so let me close the poll and share the results with everyone.
Well, we're on the right track, sort of. So you'll see what I mean as I go through the next slide. So most of you, 2/3 or a little less than 2/3 of you, say to manage the needs, which we're on the right track on that. So let's close that poll and let's get into the nitty-gritty here, because I got some interesting stuff to share with you.
All right.
Okay, so let's go on here and let's look at what I'm talking about. So when you're evaluating a learning strategy, there's a couple of things that we need to keep in mind. First is, we do what we're good at, right? We are hired for a specific reason, just like everybody's brought into an organization. Everybody who works in an organization is there for a particular purpose, because they add value for that purpose. And our purpose is to develop effective learning elements that allows people to acquire knowledge in a proper context to move them forward. Okay, so we can all agree on that. And I'm being a little succinct here, and it's not everything I show you is a complete list. I'm just giving you some examples. So when I talk about levels, I'm referring to the Kirkpatrick levels of evaluation, levels 1 to 4. And We typically, in our roles, and it's justifiable, we focus on typically level 1 and 2, which is the learning effectiveness and the retention of that knowledge. And so identifying the needs that we need to support. And that's what I call, and I'm a bit of a Big Mac fan with McDonald's, and that's just our special sauce, right? But if I dare you, you probably would never go and try to find out how they make the special sauce. Really, I don't even care how they make the special sauce. It tastes good on my Big Mac, and that's all I care about. So I don't want to know the recipe. And the learning elements is basically, learning function is our special sauce. It's what we do well. Just like in accounting, where we create financial statements and stuff like that, that's the special sauce, but we don't go bragging about it. Okay, so, but we do that well, it leads to other results. Now, the two other things that we have to look at is the infrastructure requirements required to support the learning, which is a concern of your leaders, and of course the management needs, which is the two things that that you guys picked up on the management needs, but didn't really pick up on the infrastructure needs. So the infrastructure needs is key here because that's the hard assets that need to support the learning within the organization, the technology and all this other support systems that are required. And these are capital investments and operational expenses to run your initiative. They're concerned with that. And of course, more importantly, which a lot of you targeted, was the management needs. So achieving performance objectives or business objectives at organizations. Now, these are all at Kirkpatrick's level 3 and 4, right? So, and I always say, if you're going to have an effective learning initiative, work Kirkpatrick's model from 4 to 1. And I'm proud to say that, I met Donald Kirkpatrick before he passed away a couple of times. And one time I had a conversation with him about his model. I said, I love the fact that it's succinct and it really shows, evidence or sort of an evidence of a flow that is simple for people to understand. However, if I can be so deliberate and maybe a little bit disrespectful, Mr. Kirkpatrick, I believe that people shouldn't start from 1 in learning. They should start from level 4 and work backwards, just like um, Stephen Covey once said, begin with the end in mind. If we understand the end output of the objectives we need to achieve, we can build more focused and targeted learning interventions and working backwards. And so it leads us to understanding what we need to support it and working back and building a solution that works for it. So that's where we're going with this. And that's, your leaders are focused on those two areas, not the learning elements, because again, like I said before, that's our special sauce. They don't want to know how we make the special sauce. They just want us to deliver the sauce and make the business better. Okay, so I hope that makes sense to people. So if we look at return on learning investments, there's a couple of ways we can assess this. One is, and I'm going to get a little bit of accounting here, not too much, so I hope I don't scare anybody off, but one is cost volume profit, which typically is a tool that is a return on investment tool that your leaders use on a regular basis to evaluate what lay people will recognize as break-even analysis. It's not as simple as that, but it is basically a break-even analysis. And we analyze the changes between the costs and the volume activities within the organization and the profitability of the organization. The other one is net present value, which I spoke briefly about earlier. And I don't want you to get scared about this, and I'm not going to take you through this journey. It's not a hard concept to understand, but the calculations are pretty involved. But essentially, if you remember when your grandparents used to say to you, maybe, a dollar in my day is not what can buy anything today, right? And you're probably saying that to your kids too. What I used to buy for $5 10 years ago, I can't pay for what I want to buy today. And that's basically, that's present value of money. And they look, and like I've shared with you before, they look at major initiatives, investments, or purchases over a life cycle of 10, 15, 20, 30, even 50 years, and see if the profitability or return on investment of that investment is making sense. And then they go back to the cost and try to reduce the cost and discount it to today's dollars. And the difference between the cash coming in, meaning the revenue that they're making from that asset, to the cash they're spending, the cash that's going out, so costs like training and marketing and all that kind of stuff. If the difference is positive, it's a positive net present value, and they'll go ahead with it. And that's basically net present value. And I can probably do a whole course on this and get really geeky and freaky on you with accounting on this side of thing. But that's quite interesting. And if you get a chance, speak to your finance or accounting people. It is really fascinating because you do have an impact in these ROI calculations that they do. Okay. Today, I'm just going to focus on something really more direct and maybe more down to earth that could impact. And it's a very simple example. Is around cost, volume, profit. And I think that will make it a little more relevant and interesting to you. So what I'm showing you here is what we call a behavioral income statement, or operating income statement. You probably recognize the what we call the absorption income statement that you see in financial reports all the time. But this one here, the structure of this separates the costs and their behaviors. And this is what's used internally from your business leaders to understand the behaviors of cost and its relationship with revenues and profit within the organization and the volumes within the organization. Now, I'm only sharing that with you, so not to intimidate you, and I don't expect you to remember all of this, but these are tools that impact organization. And you'll see there's a variable cost, the cost to actually attribute it to the products or services that they're selling. So it is variable because it goes with the level of sales or revenue within the organization. And then there's fixed costs. And the fixed costs is where you lie. The learning investment and everything else that support is in the fixed cost. And whenever you propose an initiative for your organization in learning, it increases the fixed cost. That's how they see it. And so something has to happen to offset those fixed costs. If you increase costs, something has to happen in the relationship. That's why it's called cost, volume, profit. Something has to balance out. The equation has to remain balanced for it to be worthwhile. So either if you're going to increase the fixed costs, they either have to increase revenue or sales or reduce their variable costs. There's only two other options. Okay, and again, you can pick this up in any management accounting textbook. I promise you that. So the question asks, if you decide to pitch an e-learning or an e-learning initiative, how will this affect the production or profit of the organization? Now, I'm going to share with you very quickly as a quick example. I use a software company that's launching a new software, and right now they're selling this software for 4,000 units at $200 a unit. So you buy it in the store, it's $200, and they sell about 4,000 a year. And to make each one, it costs $120 each unit. The current fixed cost is $200,000 in place, whatever it is, the stuff that they have to support the organization. And then they decided they're launching a new version of the software. They've upgraded, they have new features, and they realized that they need some training. They need to train their internal staff to be able to sell it or make it more, create awareness for the new features of their software. And you come up with, say, hey, let's do e-learning. We can sell more, people don't have to be tied to their desk. They estimate approximately it's going to cost $60,000 to build this e-learning initiative to get people skilled up on the new features of the new software. And the people believe, working with the other people in the team, believe that it can increase sales on the software by 700 units. Now, I'm making some direct correlations here just to give you understanding of the behavior of what's happening, but on a larger scale, you may not have those direct correlations, but still it has the same behavioral effect, okay? So let's look, and let's walk you through a spreadsheet and to see whether we should spend the $60,000 or not. Now, those of you quick in math have probably already figured out the answer. But here's the columns, right? So we have our behavioral income statement on the left, and we have the first column is 4,000 units of the current sale levels with no e-learning. The new world, if we put the e-learning in and increase sales by 700 units, and then our variance, our differences in the two worlds, okay? So revenues go up by $140,000, right? So we put e-learning in, we sell 700 more units, we make $140,000 more in revenue. Our variable costs go up because we're selling 700 units more. So to produce additional units, 700 more units is $84,000. So our profitability from this activity on the products is $56,000. Now, it doesn't take terribly a rocket science to figure out what's going on here, right? Our fixed cost was $200,000. We added $60,000 to it, and naturally, you know what your business leaders are going to say with your e-learning. We're losing money, right? Theoretically, they're not losing money. It went from $120,000 to $116,000 in operating income. They're still making money, but they're not making the same level of money, and they're losing $4,000 because they spent money on e-learning. Now, a couple of questions can come up to play here, right? You can think about when they say, okay, you gotta scale that back a bit. The $60,000 for us to break even, we have to remain at the 120, and so you have to reduce that 60,000 and find a way to do it, cheaper, and you need to figure that out. And if you can't, then maybe the other questions is the other way. Maybe the 700 units is too conservative. Maybe the real break even right now is 4750, but maybe they see selling 800. Now again, this is for 1 year. Maybe the software is going to last for multiple years, right? And so your training function is going to be, your e-learning function is going to be good for 2, 3, maybe 4 years before they renew the upgrade the software again. So you're going to see lasting benefits over time. But what I'm trying to share with you here is that building the argument, a lot of us get stuck on this 4,000 and then we walk in back to our office, not impressing the stakeholders whatsoever, and we accept what they say. What they're actually saying to you here is, we're losing 4,000, but you have to read between the lines. You have to read about what they're asking you here. So this is the question that you need to ask. Go. I hope that was helpful. And just to give you conceptual, I know it's a very simple example and a very contextual example, but I'm just trying to get you into the mindset of what your leaders may expect, and at the end of the day, they want some business impact. And even though you may think they focus only on a financial, that is the result that they want to get is, of course, improve their financial position. But they recognize that there's a lot of qualitative factors that go into the organization to make that happen. So how do we do this? And I told you, you're not supposed to make a direct correlation onto the financial outcomes. But as you can see, we do have some impact in the previous example. So I came up with, I love acronyms because, I'm like a golden retriever looking at a squirrel. I get distracted very easily. So acronyms help me out to remember stuff. And I hope this helps you. I came up with an acronym called RADAR. Get your learning on their radar. And radar means that there's these letters, R-A-D-A-R, and you'll see arrows next to them. If it's pointing down, it means you want to reduce that letter. If it's pointing up, you want to increase that letter. So let's go through, and these are questions you need to ask. So the questions that they're going to ask are is the resistance question, right? What will this cost us? A little bit to the extent of the previous example. And that's a trick question because what will this cost us means that what is this impact within the organization that this will have? So what will this cost us means, yes, there is a financial context. And you can say $60,000 like in the last example. But they're asking you, okay, it's going to cost a certain amount of money, but what overall impact are you going to have? You want to reduce the resistance from this question because that's the first, and it's not just you, don't take it personally. They're going to ask this for all cost centers, okay? The second letter is apathy. We've shot ourselves in the foot for decades. We have improved our value, and the probably reason you're sitting in this webinar is that you are trying to desperately find that value to prove it to them. So they've been very apathetic with us, and now they're being very diligently apathetic with us. We need to really show them what we can do. So what will it do for us? So not only what will it cost us, but you need to demonstrate some tangible outcomes that it will work for the organization. Again, you see the Love Kirkpatrick level that it attributes to next to it. The next one is disruptions or interruptions within the workflow. Remember, learning is an interruptive activity. And they recognize this, that learning, whether it's e-learning or real-time or on-demand, it still takes some time away from work. Whether it's 5 minutes or an hour or a day, your learning will take time away from their productivity. And each time you take away time from their productivity, employees, that's money lost for the organization. So the question is, if you're going to, and they recognize that learning has to happen, but you need to explain to them why now. Now, here's where it gets a little tricky because we've been banging on the drum about getting more technology for learning, but that's a double-edged sword, and I write articles about that with elearningindustry.com. It's a double-edged sword because you're asking for more technology, but that also means, or you're implying to your leaders that you're reducing the impact of interruptions in the workflow within the organization. Because just taking somebody out of a one-day instructor-led session and shoving them before a computer for one day before a computer is the same thing. Okay, they're looking at you to use technology to become more effective and more efficient for the organization. So understand that you want to take opportunities where there's a downturn or slowdown within it. And all the organizations I work with, including Apple, by the way, and we spent 5 years with Apple, they will take when their economic cycles are on the downswing, they actually throw more money at training because they realize that this is a time that is not going to impact the workflow as much as it was during peak times. And they'll get people skilled up very quickly. And when things turn around, they're ahead of the curve compared to their competitors, and people have learned the skills. And so you have to look for opportunities where there's downtimes, leverage technology that can minimize the impact, and explain to them how you're going to do this. Okay, so again, this has enormous amount of business impact. So you want to reduce that D. And now you want to get into the increase side, right? You want to increase application, level 3. Forget about how much they remember or how much they learned. Your leaders don't care about the secret sauce. Remember I told you that. Nobody cares what people learn. Your business leaders don't care about what people learn. And I'm careful here. They care about what people do. Okay? Our role is to get the people to do something. Okay? Take that knowledge and apply it. And that's why working backwards from Kirkpatrick level 4 to level 1 is key. When you're working with the business impact, like the questions I'm asking here, and then go to application, you can design very targeted, valuable learning elements that contribute to actually the doing part. Okay, I worked in accounting. Nobody asked me how I made my financial statements from the business leader's perspective. They don't care how I made my financial statements. All they care about is that it shows the results that they're interested in interpreting. So same thing here. They don't care how you make the learning or what people remember. They care about what that learning has done for a person to make them more, um, improve their performance overall for the organization. And the last one is to show results, which sort of speaks to the last point I spoke about. If you do all of that, you will impact the organization. So if you make people more efficient because you've shown them and trained them how to do something better or more effectively, it may save them, let's say you're on a production line and it saved them, 5 minutes per making this widget. Now multiply that by the thousands of widgets maybe produced in a day and look at the efficiency savings. Now you want to work with performance indicators of the operational department you're working on to show those results. And I speak to that in my book, The Trainer's Balance Scorecard, that you use learning the performance metrics that are valuable to the operational leaders within those organizations. Don't create your own. You're not required to create your own metrics. Use their metrics and you will look like a hero. Okay, I've talked a lot. I said a lot of stuff. Okay, and it's coming into about 12:52 right now. So remember, you're a cost center that is expected to provide benefits or specifically performance benefits, and that's what I want you to recall. So just to summarize and conclude, keep in mind that your trainings generally look at training in three ways, and we talked about those three ways, right? So understand the performance financial impact in each of those areas. Understand what learning investment means to the organization and to your business leaders. Appreciate that you are a cost center and what that means to be a cost center. Use existing ROI tools. Don't use the stuff that we're creating that they have never seen or learned, that add no validity or credibility to them, okay? You have to speak their language. Respond to their concerns. I give you a quick cheat sheet on Radar to answer questions, but you may come up with some more. Take inventory and understand that you need to read between the lines when they ask their questions. And finally, look at existing processes. Show the value between the costs and the benefits that you're offering within the organization. Make sure that you're showing that benefit is actually being applied within the organization. And do these simple things and you'll be successful in showing the value of learning. I know I've done it and I've coached people in organizations and the learning departments to do this, and they are seen, as a valued partner. They're not a afterthought anymore. They act as they are proactive business partners within the organization. For example, I took a company department once on a field trip to an operational department and made them an operational partner with that department. And the operational leader thanked me because he said, now we are working together to prove some value for our department and make our department better. So I asked you this question earlier. I'm gonna hold you to a commitment though. I don't know how I'm gonna find you, but I'm just kidding. I want you to take one thing away today and actually apply it, okay? And practice it because again, I told you it's not about learning, it's about doing. And I want you to do something. On that note, I do have resources. I do have several courses that speak to this topic on LinkedIn Learning. Two more courses were supposed to be released, but unfortunately due to COVID, that's been put on hold. But the Gain and Buy-in for Learning, and I have a new one that's not on here called Practical Success Metrics for Learning. They are very short, quick courses. So if you have access to LinkedIn Learning, please do so. I write for many publications. Some of my more popular ones are on elearningindustry.com. And of course, please, take a gander at my book, The Trainer's Balance Scorecard, a complete resource for linking learning to organizational strategy, available to Wiley or at Amazon. And I was really appreciating you being here and allowing me to share my knowledge with you and hopefully make you successful. So please join me. Sorry about that logo up there, that should be gone. Please join me. This is my email, this is my Twitter handle, and thank you again, iSpring, for having me. I'm open to any questions that you may have.
Thank you so much for this presentation. And yes, I think we're ready for a Q&A. So Rosalie is asking, how do you establish an increase in widget sales? As in how to know how much sales will increase?
Well, an example I gave was a very short example, but you're not expected to forecast the sales side of things. what you're there, what you're expected to do in that discussion. Remember, you're not the only element affecting the sales or the outcomes of the widget sales, for example. There are a lot of other players. There's marketing, there's the sales team, there's a bunch of other people involved in this decision making. So you can bring your value to the table and talk about, listen, we decide to improve, we can help you improve. You would have to do your needs assessment a little bit to understand what is the weakness in their sales side. That's your secret sauce. And then come back to them and say, we believe that if we do this and this with the sales team and improve that skill set, we can help them improve their effectiveness. However, realizing that you have to qualify that you're not the only element in helping them improve sales. So don't paint yourself in a corner. Make sure that you do your needs assessment. You understand how, if it's a sales team in this example, make sure you do a proper needs assessment to help them become better at what they do, but recognize that there's a lot of other elements that they need to also address as well. Because it could be pricing, for example, that's not the right price, and that's not your fault that it's not selling. You did your job to train the people, but if the price is too high and not competitive, that's out of your control, or anything else that may affect it. So, or distribution or stuff like that. So just be careful, but do what you do well and help them become better at what they do, and let them worry about some of the other stuff. Okay, I hope that answers your question.
Mhm. Thanks a lot. And Reem is asking, when shall we consider ROI for short term versus long term?
So again, I mean, I want to get you away a little bit from ROI. It's about performance expectations, right? Again, they don't ask marketing for ROI. They don't ask production for ROI. They don't ask HR for ROI. So it's not about the return on investment, because that implies, as I mentioned in the presentation, implies a direct correlation to income growth or revenue growth within the organization. And we're not meant to do that. What we're meant to do is have an indirect contribution to improving performance to make that happen. So if you show a cost benefit relationship overall, or cost performance relationship, that's where you want to go to show I can move this performance metric. So if it's about reducing defects, for example, then you want to, sorry, my earpiece just fell out. Then you want to show, you want to go to the production department and say, okay, what are the performance metrics you're under to reduce defects? And then identify how you can, do the needs assessment to find out why those defects are happening. And if it is with the people, and if it is with the people producing the product, then you're going to do a needs assessment to find out why they are causing these defects in the production. And then even if you help them improve that, you just move the needle. Say they want to reduce defects by 5% in the organization. And even if you move that needle down a couple of percent, you've just proven value for learning, because there could be other factors impacting, but still that shows improvement in performance, and overall indirectly shows improvement into cost savings for the organization, because they're reducing defects, and there's other ancillary benefits that come about it too, right? If you're reducing defects, it improves efficiencies, cost savings, and of course customer satisfaction, because if customers are not receiving products that are defective, you're doing your job. So there's a lot of correlation here. We're not isolated. We're one element within an overall organization, but we have an important element to contribute. I hope that answered your question.
All right, thank you very much. And I think at this point we do not have any other questions. I would like to thank you, Ajay, for doing this wonderful presentation with a lot of practical advice that our attendees can, I hope, go and use in their work. So thank you very much for doing that.
Well, thank you everyone for joining me today, and please reach out and ask me any questions you have. I'll be happy to answer you and help you in any way. That's my goal. Thank you very much, iSpring, for having me today.
We enjoyed it as well. All right, so I hope everyone has a wonderful day, and we will see you at the next webinar. Bye, everybody. Bye, Ajay.
Thank you. Bye-bye.